Hello, students. I'm Professor Enrique, and in this lesson, we are going to learn on how to assess our foreign exchange currency risk, as we talked about the previous week. I'm going to teach you how to assess the level of risk that we have on a foreign currency. Remember that we talked about some of the key terms that we need to know, like first defining what currency we will use to create our accounting database. Like, for example, in the US, they use US dollars, even if the investors are based in Europe. For a company based in for a company that it's in the US, operating in the US. But another example can be a company that it's operating in Mexico. They will use the local currency to register their accountancy ledger, and this is because they have to follow tax laws. So even though maybe the investors are from the US, for example. So we will have our operational currency, which is one of the terms, and the other term is the reporting currency. Obviously, if you have an investor which is based in another country, you have to report them in a different currency that you're currently using. Like, for example, in Mexico. So if I have an investor in the US, based in the US, I will have to translate my financial statements in order to report them in US dollars, so they can or are able to read the financial statements properly. So regarding the translation, there is some exposure. You will have a translation adjustment risk. We will assess this on the chapter 8. This is furthermore in the course, and we will know or figure out how to hedge the risk that we are going to assess in this lesson. Well, that's on chapter 7, on hedging the currency translation, the currency exchange risks. So first of all, we will start on how to assess the level of risk. And this also applies not only for foreign currencies, students. This also will help you to assess a risk for other type of assets. You can also identify a risk in the same way as we will assess a foreign exchange currency risk. You can use it for assets and commodities, and another type of assets, like maybe stocks. But first of all, we will learn how to assess the exchange risk, because this is one of the most common cases that you will see in companies, like we just saw in the previous week, how to register an exchange gain or loss on a selling transaction. So let's begin, guys. So everything starts with a trial balance. I don't know if you remember what it's a trial balance. This is the summary of all the chart of accounts on any accounting system. And here you will see the final balance of all the debits and credits on each account. The important part in here is that you will have to figure out from each account what is the exposure of a foreign currency. Like, for example, in the cash account, which is basically summarized in banks, you can have in the same case that we're just talking about, the Mexican company. The Mexican company will register their accounting in Mexican pesos, which is the operational currency. But that doesn't mean that they are not, or this company is not able to receive US dollars. It's very common that in Mexico you have US dollars, like we just saw in the previous week, with by selling to American-based companies or exporting some of your services, or maybe by receiving American customers, you may be encountered in a case where you have to open a US dollar account. And that US dollar account will be recorded in US dollars, but your accounting system will translate it into Mexican pesos, like we just saw in the previous week. And that will happen also with account receivable. Maybe you will have contracts with customers that are in US based, and maybe you will record because they owe you $100, but your accounting system will translate those $100 into Mexican pesos in the exchange rate of the day of the operation. So once you have your trial balance, one of the basic reports that you will have to use, even for internal control purposes, that it's one of the final lessons, you will see that why. You will have to find what it's called an account receivable aging. In here, you will have a detail of customers with the total balance due to you. So ABC Inc. owes you $100,000 in total, which is outstanding 10,000 of them. So this final balance has to match with your trial balance. These are not related reports, but it's just a matter of for you to learn how to review this reporting. Obviously, this will give you the totality of the account. That means that what you're reporting matches with this report. That's the first thing that you have to do. The second thing to understand, guys, is from this list of customers, you have to figure out which one of those owes you in a foreign currency. Okay, maybe ABC Inc. owes you in Mexican pesos. So we don't have any exposure in exchange, in foreign currency exchange. But maybe the next customer owes you in US dollars, even though those dollars are translated into Mexican pesos. So what you have to figure out is you have to know the full amount of all the customers that owe you in other currency, like in this case in US dollars. You will have to add up all the balances in US dollars. For example, if you have in here that all the customers that are based in the US and that owe you in US dollars are 500, you will have to do a report like this, which is a foreign currency risk exposure report. As all your reports, you have to title them at the beginning. And I didn't use the same example for the banks, guys. because the bank sales are self-explanatory. If you have a US balance account, you obviously have to add them up, all the accounts that you have in other currency or other foreign currency besides the operational currency. Well, you have to add them up and list them in here. Like, let's do it for this example, like 200. All my US dollars accounts, add them up to 200 plus the account receivable. So you have a resource, you know that the assets are resources. You have 700 of US dollars of, in this case, in this example of foreign currency risk. The final step is to decrease those resources with the debts. And it's the same case as the account receivable. You have to go with accounts payable and accounts payable aging reporting to know the detail of the different suppliers that you that you owe them, the ones that you have debts. Obviously, not Mexican pesos debts. You have to use the same logic for the payables. You will add up all the debts in US dollars, and subtract them in your report. So as you figure out, this foreign currency risk exposure report only has influence from the balance sheet accounts. You don't have to add profit and loss accounts into this, guys. It's only a matter of balances. Okay, and we will review two cases which are the first case is when your final balance goes in a positive. Like in this case, we have 500. Why? Because of positive balance, because we have a $200 exposure in the bank's balance, 500 in the account receivable, and minus, or we have to decrease the accounts payable balance of 200. So we have a final balance of 500, which are positive of final exposure. What does those 500 means? Well, that means that if you collect all the receivables and you pay to all your suppliers, you will end up with plus 500. And with that exposure, you will now know what to do. Because what would happen if the price of that currency gets appreciated or depreciated? We will see a great example in here, based obviously in operational currency, which are Mexican pesos. So if your net position becomes positive, the company will be affected if the price of the foreign currency is depreciated. What does that mean of depreciation? If the US dollars get depreciated, that would mean that you will have to use less pesos to buy $1. So if you want to go to the market and change those $500 that you have and change them to pesos, when yesterday they were at 20 pesos, but right now that you have the 500 and you want to cash them out and the currency exchange rate is 19 pesos, then you will have losses because you will receive less pesos that you would before. Okay, and the same thing happens if the well, not the same thing happens, it's in reverse. If the currency gets appreciated, you will have to use more pesos to buy $1. That means that you have exposure. If it gets appreciated, you will win because you will receive more Mexican pesos for your dollars. In the other side, you will lose if the US dollar gets depreciated because you will receive less Mexican pesos for your $500. And that's the example on how you get your risk exposure. But let's see the other example, guys, when you have a negative exposure. And the negative exposure, it's just telling you that you have an account receivable of 500 and you have in the bank balance 200. So at the end, you have $700, but you owe accounts payable balance for 1,000 in total. That means that you will have to go to the market to buy $300 that you're still missing to pay all your debts. So you will have a negative exposure. And what would happen with a negative exposure? Well, you will have to go to the market and purchase those US dollars. So if your net position becomes negative, the company will be affected if the price of the foreign currency it's appreciated. Why? Because if the foreign currency it's appreciated, that means that you will need more Mexican pesos to buy $1. That means that you will need more resources to purchase $1. So that means losses for you. So you are not expecting that, or you don't want, or you have to cover yourself in this situation if your analysis of that foreign currency gives you a result of an appreciation of that currency. In the other side, otherwise, if the foreign currency gets depreciated, you will win because you can go to the market with less pesos and buy $1, and you can pay to your suppliers compared to maybe to the currency, the exchange risk, the exchange rate that you had in the original operation. Okay, well, that's all for this foreign currency risk exposure. Now you know how to get your risk exposure of foreign currency, guys. And in another lesson, you will figure out how to hedge this exposure, this risk exposure. Thank you very much for your attention. Bye-bye.